The topic for today is monetary policy. Monetary policy, as most of us know it, is the policy used by the Reserve Bank of India to control interest rate, money supply and credit creation in the economy. And how does RBI do it? RBI does it through certain instruments that can be both qualitative and quantitative. So today we'll be discussing about some of the quantitative instruments. And before we start looking at the quantitative instruments, let's see how can the RBI affect the interest rate or the money supply or the credit creation in the economy in very simple terms. So as we mentioned earlier, how does banks work? Banks work by taking in deposits and giving out loans. But let me break the bubble. There's one more important thing to note, that is the RBI. So the banks don't just get money from the deposits to give out loans. The banks also get money from the Reserve Bank of India to give loans. So it takes money from the Reserve Bank, it takes loans. So the bank takes loan from the Reserve Bank and it takes that money and lends it to the public. Okay, so it's a cycle of people taking loan and giving loan. We'll look at it. And it is through this route by which the RBI tries to influence the money supply in the economy. So let's look at a very simple example. Let's say the RBI is lending to the bank and in turn the bank lends to us. So if RBI lends to bank at an extremely high interest rate, then chances are the banks lend to us at an extremely high interest rate. But if the RBI lends to the banks at an extremely low interest rate, chances are the banks will lend to us also at an extremely low interest rate. And that is how the RBI affects the interest rates in our economy, or the interest rates that directly are paid by the general public, that is us. Okay, so today we'll be talking about one major instrument, the most popular instrument that most of us already know. It's called the repo rate. Now what is the repo rate? One thing we know by now is that RBI lends to the banks. So repo rate is the rate at which RBI lends to the banks and which money is in turn used by banks to lend to the general public. And repo rate is the money, or is the rate at which the RBI lends to banks for short-term borrowings. And by short term I mean 7 days, 14 days, 56 days. And one important thing to note about repo rate is that repo rate is also called the repurchase agreement, because whenever the bank does a repurchase agreement, or whenever the RBI does a repurchase agreement, it clearly states that we are giving this loan to you, but you have to give it back within 14 days, or you have to give it back within 56 days. And that is how it becomes a short-term borrowing. And that is what repo rate is. Now let's see, how does repo rate impact the interest rate, money supply and credit creation in the economy? First of all, if the repo rate increases, it means that the rate at which the banks have to borrow, or the banks borrow, becomes expensive. So borrowing becomes expensive for bank. Borrowing becomes costlier for bank, and if borrowing is costlier for bank, the bank is not going to give us the money at any cheaper cost. That means the interest rate will become higher for us also. That means borrowing becomes costlier for us as well. Borrowing becomes costlier. That is a relation with interest rate. Interest rate increases. Now when repo rate, that is the first combination or comparison. Second is when repo rate increases, what happens to credit creation in our economy? When repo rate increases, the bank finds it more difficult to borrow more money because it's costlier. So the bank borrows less money. And when the bank borrows less money, the bank has less money in turn to lend to the people like us. And hence the credit creation will reduce, because the bank has less money. Only when the bank has enough money can it lend money. So if the bank has 1,000 rupees, it can lend 800 rupees. But if the bank only has 500 rupees, then it can only lend 400 rupees. That is the second comparison. Now the third is when repo rate increases, what happens to money supply in the economy? Now when interest rates are high, it is more expensive for you to take a loan. At the same time, when credit creation is low, there are less loans available in the market. Now when there are less loans available in the market and loans are extremely expensive for you to take, do you think you will take loans? No. And when people don't take loans, what did we study in money multiplier? That if we don't take loans, then the money multiplier does not really work. And what happens is money supply decreases. Because loans are expensive and there aren't enough good loans or aren't enough loans available, the money supply will decrease. And by doing this, the RBI or the government basically decreases money supply in the economy. That's a major thing that is done by them. They decrease money supply in the economy. So this is about repo rate, okay, and about the first quantitative instrument, which is also the most important.